If you're trying to buy a home right now, you already know something's broken. Prices are up, rates are high, inventory is gone. And somehow it's still not 2008. In 2008, the housing market collapsed. In 2025, it's stuck. Back then, millions lost their homes because they borrowed too much. Today, millions can't buy a home because the system has priced them out. This isn't about bad loans. It's about a market that no longer works for the people living in it. We're not heading for the same kind of crisis, but we may be drifting into something even harder to fix. As a homeowner, you're rarely afraid of your house going up in value. But what happens when housing becomes so expensive, so unreachable, that it breaks the system? This is the story of two booms, one that ended in disaster and one that's still waiting for a trigger. Let's go back to the early 2000s. After the dot-com crash, the Federal Reserve slashed interest rates. By 2003, the federal funds rate was just 1%. Cheap money flooded the housing market. Home prices climbed year after year, but wages didn't and rents barely moved. From 2000 to 2006, home prices nearly doubled in many cities, but rents rose only modestly. In some of the hottest markets, the price-to-rent ratio soared. That's how we know this wasn't about fundamentals. It wasn't about income or rental demand. It was about belief that prices could only go up. Credit flowed freely. No income verification, no down payment. Adjustable rate mortgages with teaser rates that would reset after 2 years. For a while, it worked. But by 2006, the Fed had raised rates back above 5% to cool the economy. Those low teaser rates reset, and millions of borrowers couldn't keep up. Defaults surged, foreclosures exploded, and the mortgage-backed securities tied to those loans imploded. By 2010, over 8 million homes had been lost, and the financial system had nearly collapsed. Now, fast forward to the 2020s. In early 2020, the pandemic shut down the economy almost overnight. Millions lost jobs, businesses closed. The US entered one of the sharpest recessions in modern history. So most people assumed housing would follow, that prices would fall, that demand would disappear. Instead, something strange happened. The housing market surged. Mortgage rates fell below 3%. People fled crowded cities. Remote work made space more valuable, and trillions of dollars in stimulus flooded the system. Suddenly, everyone wanted a house, and everyone could borrow cheap. Demand soared, supply stayed tight, and prices skyrocketed, faster than almost any period in modern history. By 2022, the boom had peaked. Home prices were up more than 30% in just 2 years. But then inflation surged, and the Fed raised rates aggressively. By late 2023, mortgage rates had climbed above 7%. Affordability collapsed, and the housing market froze. Not crashed, froze. In 2008, millions of borrowers had adjustable rate mortgages. Their monthly payments were low until they weren't. After 2 years, those teaser rates reset. Suddenly, people owed hundreds more each month, and most couldn't refinance because home prices had started falling. Defaults surged, supply flooded the market, and prices collapsed. But today, most homeowners have fixed rates. Under 4%, they passed income checks. They made real down payments. They're not being forced out, they're choosing to stay put. And that's the trap. Sellers don't want to give up their cheap mortgages. Buyers can't afford the new ones, and the gap between them never closed. The result isn't a flood of supply, it's a standoff. Prices remain high, not because the market is strong, but because no one's moving. Affordability has collapsed, but the inventory never came. The result is a gridlocked market, one where fewer homes are being bought, fewer are being built, and fewer people are able to move. But the cracks are forming, just in different places. Multifamily construction is peaking just as rent growth is slowing. And regional banks are sitting on trillions in real estate exposure, both residential and commercial. And while existing homeowners may feel secure, new buyers are walking a financial tightrope. Many are stretching their budgets just to qualify. Some are turning to FHA loans or longer mortgage terms. And if the economy weakens, that's where the pressure will show. Because no matter how good the underwriting was, a job loss can make any loan feel unaffordable. If you want to see how Walmart and Amazon are rewriting the rules of money itself, check out our stablecoin video right after this one. Because real estate may be locked, but liquidity is moving somewhere else. Now add one more variable, tax policy. President Trump has proposed eliminating capital gains taxes on the sale of primary residences. Not just the first $250,000 or $500,000, all of it. The goal is to unlock trapped inventory. Many longtime owners are sitting on huge gains but don't want to sell and face a tax hit. This plan could change that. It might encourage listings in high-equity metros like California or Florida, but it may also push prices even higher. Because unless mortgage rates fall, unlocking supply won't fix affordability. And this change, like many others, mostly helps people who already own. While the residential market is stuck, commercial real estate is slipping. But it's not collapsing everywhere, it's splitting in two. Some high-end buildings, especially in places like Manhattan, are recovering. Top-tier offices with strong transit access and premium amenities are attracting tenants again. Foot traffic in parts of New York is almost back to pre-pandemic levels, and leasing activity is rebounding for a handful of Class A towers. But that's not the whole picture. Nationwide office vacancy remains above 20%. In many cities, especially in older or suburban buildings, entire floors are sitting empty, and those properties face something prime offices don't. Loans coming due at much higher interest rates, with fewer tenants and lower rents. From 2024 through 2027, over $2 trillion in commercial real estate loans will mature, and many of them won't pencil out. Some landlords are defaulting, others are handing back the keys. Banks, especially regional ones, are exposed to those loans. And in a few cities, commercial vacancies are already bleeding into city budgets and local economies. So yes, there are signs of stabilization. But the stress isn't over. It's just uneven. And in the wrong portfolio, that can still break things. This isn't about bad credit. It's about maturity risk, interest rate exposure, and falling collateral value. The danger here isn't mass foreclosure. It's a slow grind. Buyers shut out, sellers trapped, banks under stress, and housing absorbing a larger share of household budgets than ever before. This time, the system didn't overheat. It locked up. And locked systems tend to break. Not all at once, but one piece at a time. If this helped you understand where we really are in the housing cycle, like, share, and subscribe to Global Notes by JP. Because the next crisis won't start with bad loans. It'll start with a locked system, a trapped middle class, and a policy that pushes just a little too far. And when it breaks, it won't look like the last one.